Doug, I have some clients that are sitting on some real estate that maybe was worth a little profit and now might be losing money. What do you suggest people do in those situations?
Yeah, I think that the concept of holding every asset till the end is a bad concept. A lot of people believe that once you buy it, you just put it away. At the end of the day, I don't think that every asset is meant to be kept long term.
What's the advice for an owner when they're staring down and they thought they might make a little money and then they thought they may break even and lose a little and now maybe a lot? But,
Yeah.
And I have clients in all those stratospheres right now. What do you do when?
That's tough. It's easy to say what to do. It's tough. It's tougher when you're in that position.
Yeah.
And fortunately, as a property owner, it at least gives me the perspective and the empathy.
Yeah.
But this is where I take something from. I love taking things from different markets, different industries, and taking ideas from smarter people, and then trying to apply them to what I'm doing.
Yeah.
This question reminds me of is Peter Lynch was the lead fund manager for Magellan. And one of his concepts that he taught me, very, very early on, is the difference between successful traders and losers. And successful traders, they have a expectation for their stock. If it doesn't meet it, they sell it. They go buy another one because it takes too long for the stock to recover or it doesn't recover. And what happens is by doing that, they end up with a portfolio of winners because they keep shedding the losers. Contrast that with the amateur. The amateur goes out and he buys a stock and it doesn't perform and holds on to it and says, we'll see what happens. And then he has a stock that does pretty well and he says, well, I think I'll take a little profit. So he takes profit. So over time, what happens is your amateur investor ends up with a portfolio literally of losers because he won't sell. I saw this as a broker and then as a principal, and I thought, you can apply this to real estate. If you don't have an asset that you have a lot of confidence in, you need to move on. And there's a chart that I used to use. Gosh, it'd be fun to see if I could even find it. And it just shows the market going down, and it shows basically what you have to do as an investor, as a seller. If a market's going down, you can't go across and meet the market. Because by the time you get it under contract and you go through the marketing process and get under contract, the market is slid again.
You find out inflation didn't go down. It went up, just like we did.
And rates go the wrong way. So the guys on the buy side go, you know what? We're going to blow out of this one. So you actually have to drop down a little bit and go across to catch the market. And it's a really tough concept, especially when your asset was worth 10, 20, 30% more 18 or 24 months ago. But we don't make the rules. We just have to play by them.
It kind of loops back. It does loop back to that property I bought. You helped me buy the first one. I was on the phone with a mentor and said, I hear never sell, never sell, never sell. You just sold your whole portfolio. And he said, well, is there a certain property that always comes to mind when you're in the shower that you just think about and not in a good way? It's that first one I bought. And he's like, then get rid of it. And we got rid of it and we exchanged it, and it ended up being really good. But there's that mental aspect that has nothing to do with the discounted cash flow. You just kind of know in your heart of hearts when it's time to move on from a property.
Without a doubt. And I promise you're going to have assets you wish you had sold sooner. You're going to have assets you wish you still owned. The key is just not to think about it and just keep moving. Just go after the next one.